I'm Howard Greenwell. The hemorrhaging in equity markets continues today, a reaction to the United States losing its coveted AAA credit rating. S&P did the deed on Friday night, meaning in theory U.S. sovereign debt is no longer risk-free. Meantime, in the Eurozone, the European Central Bank is buying up Italian and Spanish bonds, pushing down rates in those countries. It's all part of an effort to prevent interest rates in Italy and Spain from getting into default territory as those economies struggle to come to terms with large debt loads. Joining us to discuss the situation today are Ed Devlin, Executive VP at PIMCO, Alex Jershevsky, Managing Partner and Founder at Recovery Partners, and our Monday regular, Randy Cass, founder of First Coverage. Good of all three of you guys to come in today. Thanks a lot. Alex, what do you think? I mean, we've talked about this a million times over the last year and a half. Where are we today?
Well, Howard, it's the Keystone Cops. You know, you had this error in the press release, the $2 trillion baseline mistake on Friday. Treasury shoots back to S&P saying, you know, you made a mistake, we shouldn't be downgraded. S&P says, well, no, it's really because you got a lot of political risk, there's some dysfunction in your governance process. But anybody who's been conscious for the last couple of years knows that this was on the way. The question is whether this is the start of a trend that's going to accelerate, or does it stop here? Does it stop at AA+ the way it did with Canada in the 1990s, and then after a couple of years you remediate and you go back up to AAA? I mean,
it took 10 years, though, for Canada, right?
No, it didn't take quite that long. They were downgraded in 93. They got the AAA back in 97. In New Zealand, we were downgraded to single A+ in 91. And the AAA came back in 99. It can take some time, but the question for the U.S. really is this the start of something else? From my perspective, the political dysfunction is only starting now because this 12-member committee of wise men on the debt restructuring are only expected to present the plan in Thanksgiving. And then the plan gets a vote from both houses around Christmas. So we've got, 3 more months, 4 months, where there can be a lot of political wrangling, a lot more headlines chewing up the scenery, and presenting, again, a picture of dysfunction in the United States. That's part of the issue here.
In between now and then, does Moody's come out and downgrade? Does Fitch come out and downgrade as well?
I can't believe that there hadn't been background conversations on this whole issue, because unless 2 rating agencies give you the same rating, a lot of the funds that have to invest in only AAA paper can still continue to invest in the U.S. paper at AA+. If Moody's were to have downgraded at the same time, that would have been a big problem. Let's see how this plays out over the next couple of months. Let's see what Moody's and Fitch do. Yeah, I have to say that I don't agree with the role of a central bank as being a participant in local bond markets. We had this conversation when I was in the Treasury in New Zealand about whether or not the RBNZ should be intervening, because we had a lot of hedge fund activity and the bonds were a real rodeo market during the 90s with all the uncertainty in New Zealand. And I'm more of the opinion that the central bank should stick to its knitting and just focus on inflation. These guys could potentially getting themselves into a very large roach motel in trading against the likes of Ed, Michael Sherman over at Goldman's, and the rest of these folks. And they could potentially be looking at a very large hole in their balance sheet if this thing goes wrong. Spain has about 600 billion euro of cross-border debt to the big three, Britain, France, Germany. Italy has 1.4 trillion of cross-border debt to those players. I mean, this is potentially a bottomless pit for the ECB to get into and involve themselves in a game of chicken with some professional people.
But is there an alternative, just like it was viewed that there was no alternative in 2008 for the policy responses?
Well, yeah, there is an alternative. The alternative is to get the fiscal house in order, to start making, demonstrations to the market that things...
But how do you get Italians to pay more taxes? I mean, that's the question.
If they can't pay more taxes, then the problem continues and they go bust. And you have a restructuring. That's what...
way out of this, right?
They're all bad choices. You can't stop contagion once it starts. The contagion's already there.
The notion that we can get through this rough patch is all predicated that growth is going to give something to the top line that gets you through this rough patch. But show me someone somewhere who has said this is where growth is going to come from globally even right now, right? So all these projections on the top line that these stopgap measures will help balance the budgets for a little while and cover the holes, it's ridiculous if you don't have the growth that comes, and the growth isn't there.
Exactly.
So exactly. It's a long time to make reforms.
But it may never happen because these guys are going to run into trouble. The central banks are trading against professional traders. They're starting to take on big asset positions. The Fed, for example, in my opinion, is in a roach motel that it will never get out of. What this is, it puts you on a treadmill to money printing and inflationism.
Nothing makes speculative, levered portfolio managers drool more than a central bank standing up and saying we're going to defend the currency or plug a gap here.
Yeah.
Because you know at some point, again, the political system is no longer going to allow them to run the country in that manner, and the hedge fund managers and the portfolio managers are on the other side of that.
For sure. And, you're trading by committee. You've got Barroso and, the French finance minister Barra now saying, we're going to increase the size of the FSF, we can ramp it up. Actually, if you do the math, you can't get to a point where these guys can absorb the debt required without a catastrophic decline in ratings in the Eurozone generally. If you ramp up the stability mechanisms they put in place to $1 trillion or more, you're looking at AA, single A credit ratings descending on the Eurozone, affecting all of the countries there.
QE3?
I mean, Geithner was doing an interview last night where he said there's a role for government and there's a role for central banks going forward. I don't think he was just talking about Europe. I think that was the first kind of public expression that we're on board now, guys. And I don't know if they'll want to call it QE3. I mean, I should go get that domain right now, QE3.com. but they'll figure out some way. I mean, there's no downside to them throwing more money at this because they're so deep in it right now.
That's more of the bridge.
But we've said this for a year, that once you get on this QE treadmill, it's very difficult to get off. We've been calling for a QE3, QE4, QE5. They've only got one tool, right? At this point, interest rates are zero, so they've only got the bond buying, the money supply tool. And they're going to do it. They might call it something else, as Randy suggests. One way or another, Bernanke's going to get his way.
I mean, this is the greatest practical exercise in economic theory that the world has ever seen. And we'll find out.
We're in the test tube.
This is it.
We're in the test tube now.
All right, we will take a quick break and come back to the test tube right after this. Please stay with us. About 30 seconds.
I think the solution is to acknowledge that this thing is going to result in haircuts and bank failures. And until the authorities come to that conclusion and start acting proactively to generate a controlled meltdown, we're going to continue to see these patches applied with the risk of a much larger, uncontrolled meltdown awaiting us in the future at some uncertain point. A point that we can't tell when it's going to happen and how big it's going to be and who it's going to affect. These guys need to get their heads wrapped around the fact that losses are going to have to be shared. In these type of situations, the best solution is usually one that nobody likes. And right now, we're not at that point in terms of decision making.
Got to go. Great to have the three of you with me. Many thanks to all
Thanks,
of you. Ed Devlin, Alex Drashevsky, and Randy Cass. If you missed any of today's program, watch it online at bnn.ca, and you can send us a comment at headline at bnn.ca. You're watching Headline on BNN.